Today we're sharing our thoughts on how to manage financial risk in early retirement.
We became financially independent and retired just 6 months ago. Since then, we have seen a global pandemic with a huge impact on the global economy.
Stay with us till the end of the video because we'll share how we're dealing with the crashing stock market and its effect on our early retirement plan.
To everyone following our story, thank you so much for coming back for another episode. We're all settled here in Canada after making our big escape from Italy. And if you didn't catch that story, we will link it up in the description below. If you're new to the channel, I'm Stephanie.
And I'm Gillian. We're a couple who saved and invested our way to financial independence, which allowed us to retire early and head off for a life of slow travel.
If you're looking for how-tos for early retirement, we've got lots of content for you. So click on that subscribe and the little notification bell, and you'll be informed every time a new episode comes out.
Today we're talking about how to manage financial risk during early retirement. At the end, we'll share our own approach and how we're dealing with the current market downturn.
For background, we retired early just 6 months ago, and our big plan was to spend 2 to 3 years traveling the world with a focus on low cost of living countries, such as those in Eastern Europe and South America. And if you'd like to know more about the lessons that we've learned from our past 6 months of early retirement, we'll link up the video in the description below.
Our plan is suddenly up in the air since, like everyone else, we're caught up in the COVID-19 lockdown and the likely recession ahead.
So we're experiencing firsthand what happens when an early retirement does not go to plan. Just to flag though, we are not financial advisors. We've just done a lot of research on this topic and we wanted to share our thoughts with you.
Risk management starts even before you retire by coming up with the right amount of savings to support your expenses for the rest of your life. We have a video that provides some tips on that topic, which we'll link up in the description below.
In that video, we talk about the need to accumulate the right amount of savings. So the rule of thumb that many people follow is to save 25 times your annual expected expenses for once you're in retirement. To us, saving 25 times your annual expenses is really the bare minimum. And in fact, for ourselves, we personally choose to follow a much more conservative approach. So that could be saving 33 times or even higher.
This amount should be large enough to protect you in case of unexpected events, such as a change of life circumstances, prolonged market downturn, or a rise in healthcare costs.
We talk more about how to come up with the right amount of savings in our free 7-day email course, which is intended to help you design your ideal post-work life. So you can sign up for it now. There's a link in the description below. Another important consideration for risk management is to be mindful of how your savings have been invested and how diversified those investments are. For example, what proportion of your savings are in equities versus bonds versus real estate versus other investment vehicles.
Of course, some types of investments are more volatile than others. Just think of the recent market crash. So consider whether you're diversified enough in case one part of your portfolio is impacted.
For example, if you're heavily invested in equities, then a stock market crash or downturn is going to have a major effect on your portfolio. Similarly, if you're very invested in a single property that you bought at the height of the real estate bubble, that too could have a real impact once there's a downturn.
We won't go into too much depth on investing in this video, but the key takeaways are to diversify and to allocate based on your own risk tolerance. Whatever investment strategy is right for you, you will still need a cash flow to fund your living expenses on a day-to-day basis during your retirement.
Your cash flow during retirement can come from a variety of sources. So it might be in the form of regular inflows from pensions, dividends, or maybe returns from fixed income investments. And there can be other cash flow sources as well. So there could be rental income. Maybe there's a side hustle income because of course you don't necessarily stop earning money once you've stepped away from the corporate world.
On the other hand, if you're 100% invested in equities, you would need to gradually sell these off in order to fund your living expenses. Now, if your cash flow is disrupted for some reason, whether it be a market downturn or a tenant who's behind in rent, it's a good idea to have some cash set aside to get you through that period, essentially to protect your cash flow.
The amount of cash that you set aside should be enough to cover your needs for the amount of time that makes you feel comfortable. For some people, that will be 1 year. For other people, it could be 3 years. Having cash set aside is particularly important in case your investments have poor returns over a number of years. So having that cash means your living expenses will be covered and you don't need to sell off investments while the markets are down.
All right, so your cash flow covers your expected expenses, but what about those unexpected expenses? These are things that are above and beyond what you would normally expect and budget for.
This is where an emergency fund comes in. Now, the amount that would go in your emergency fund is ultimately very personal. It's what you're comfortable with. Some people might be comfortable with as little as 1 month's worth of living expenses. Other people would look for 3 to 6 months. Everything that we've mentioned so far, diversifying investments, protecting your cash flow, having an emergency fund on hand, these are all very important tools for managing risk. Equally important though is to simply have a plan in place for how you'll respond to a situation when it arises. This is essentially scenario mapping.
We recommend sitting down with your partner or yourself and coming up with a plan for a variety of scenarios. Then write it down so that you're committed.
Potential scenarios that you may face in retirement could include a market downturn, it could include an unexpected illness, or a change in family circumstances, just to name a few.
Consider what scenarios might be relevant to you in your life and think how you would respond in terms of financial management.
It's important to remember that you have a range of levers available to you if you need to respond to any financial situation. For example, if you need to reduce your living expenses, you can always try living a little bit more frugally.
Or you can lower your cost of living by moving to a less expensive city or even country.
Or if you have a need to generate a bit more income while you're waiting for markets to recover, you could choose to return to work, either full-time or part-time, or even start a side hustle.
Now we wanted to share how we're personally dealing with the current economic crisis and how it's affecting our early retirement plans.
As we've mentioned, when we were planning for our own retirement, we were quite conservative. So we didn't just save up 25 times our expected annual expenses, we saved much more so that we could feel very confident in our financial future.
Additionally, our investments are a mix of equities and fixed income. For equities, we hold a low-cost global index fund, which gives a slice of the overall market. For fixed income, we invest in syndicated mortgages, which provide regular interest payments. And this is what we use to fund our everyday living expenses.
In the current economic situation, we're finding that the steady payments from the fixed income portion of our investments really is very reassuring, and it helps smooth the ride while our equities recover.
We also have 1 year's worth of expenses in a high-rate savings account, and this helps act as a buffer in case there are any disruptions to our cash flow.
Now, we encountered a lot of unexpected expenses when we had to cut our European travels short and fly back to Canada. Fortunately, we had accounted for the unexpected in our emergency fund, so we were able to manage the cost.
Generally, our most important lever for managing risk is keeping costs low by including lower cost countries as part of our travels. Now that we're back in Canada, the costs are a little bit higher, but the same principle can still apply by spending some time in smaller, less expensive cities.
If this topic of managing risk was helpful to you, we have a video right here that lays out the key steps for coming up with the right amount of savings to fund your retirement. Feel free to click on it right now and give it a watch.
If you enjoyed this content, you can let us know by hitting that like button, and don't forget to subscribe so that you don't miss our next video. Thank you for watching, and we'll see you here next time.